what's more important for the listeners is Rethink's volume, I'd say, is about 35% regional. The other 65's in the capital cities. Like, we're back on. It's a bull run again. So builders are going to be back because they've been on the sidelines for 2 years.
In order to get your money to work harder for you, you probably need to go to the regional towns in order to get bang for your buck.
If you take that $5 million to a town with 50 to 100,000 people in it, you're probably talking shopping centres. So you might get 4 times the building size, you might get 3 or 4 times extra tenants, like you've got a better yield. Instead of it being 5.5%, you're 7. Like it's a considerably different deal.
3.5, maybe 4 years.
Perth has probably been the unicorn of the last few years.
Did you need a marble staircase?
No. Yeah. So why not?
G'day, how you going? Phil Tarrant, co-host of Inside Commercial Property with Scott O'Neill, the brains trust behind Rethink Investing, the Rethink Group. Scott, how you going? Good to see you.
Very good, mate.
Here we are back
Episode
again.
64. It's getting on.
You got a good town for a bloke in the winter.
Yeah, just got back from Europe and did five weeks this time, which is less than normal. But yeah, no, it was good. Did mostly just Greece and just had lots of visitors at our place over there, and drank a bit too much and didn't do as much work as we normally do. But yeah, it's sort of good to get back into it, really.
Did everything fall apart while you were gone?
Not like I used to. No. You know, the business has been more sturdy, but I think I've quoted once before on this podcast, when I used to leave in those early years, the business revenue would drop up to 30%.
Wow.
And so it'd be
it's
a
an
punishment.
expensive holiday. Yeah.
When you look at it that way, the opportunity costs were massive. And because I was just doing so much of it myself, and like you just turn off marketing and all that because you're not really there to help as much. But it's such a good process machine now. The business it doesn't really miss me like it used to.
What about the portfolio? Was it nice and stable while you were gone? A lot can happen in 5 weeks.
Good question. I haven't looked at it.
Okay,
So
there you go. So it's pretty stable.
Or it could mean we're not looking at it
and
there's problems. But hopefully it's not too bad. It is ticking along nicely these days. We're in the middle of getting a DA, which has been approved for the office in Bondi.
Okay,
so
very
that
good. When's all that starting? Is that
next couple of weeks?
Okay.
Yeah, we're just sort of like talking to builders and all that kind of stuff at the moment. So haven't signed dotted lines and that, but it's amazing how much the costs go up. Like we always say, you get the first draft invoice and it's pretty much double by the time, and we haven't even started the job. So God knows where that'll end up.
It's probably worth a podcast just around fit outs, I reckon, because what you think you want versus what you actually need are two very different things. And
I know
when you start, if you let your architect run wild, who normally do all the specifications, they typically choose the most expensive stuff, but you can actually get the same look and feel with a lot less cost if you're smart about it. But
well, we did. We're doing a full marble staircase in this thing, so it's kind of like a bit fancy. But it's some quotes came back for $800,000 for this one staircase, and then you can get it made in China with the exact same material for $250,000. Still $250,000 for a staircase, but that's a pretty big cost saving just by doing one thing different.
Absolutely. What about lead times and all that stuff? Is that more extended?
26 weeks, generally. So pretty good for the size of the job. That includes putting a mezzanine in, so structural work, everything from air cons to fancy tiles and all that kind of stuff. So
did you need a marble staircase?
No.
Yeah.
So why not?
You want a marble staircase?
Yeah, it's kind of like a feature. So it's kind of like the way the building is orientated. It's got this corner, so the corner's all glassed out. So you'll see the staircase through that. Glass section.
Statement piece.
So either that or put some weird statue or something. So
I'm sure
do something practical.
The Greek Adonis that is. You spent 5 weeks there, so maybe you can emulate that, and maybe get really want to leverage your skill set, your knowledge and understanding around this to get insight. So I know your personal portfolio, you got a fair bit of resi in there. You got a fair bit of commercial, which is rural and or regional.
Yep.
Yeah.
Yeah. So we're like. My portfolio is mixed. We're from Perth to Brisbane, Harvey Bay, got like Hobart as well. So look, a lot of it is capital city, but there is a lot of them is kind of fringe type suburbs and stuff like that. But I guess what's more important for the listeners is Rethink's volume, I'd say, is about 35% regional. Okay. The other 65's in the capital city. So we're definitely skewed just by volume slightly to the capital cities, and that's just due to the nature of the market. More deals, the dollar amounts as well. I'm talking dollar amounts, not number of deals. But in the last couple of years, the regional markets have looked better, especially with the higher interest rates and because the yields are higher in the capital cities. It's also cheaper as well. So it's a bit better if you've got less budget to work with. You can get more bang for buck there. But yeah, look, the reality is a bit of both is what you want. Just like residential and commercial, you don't go all in one, and you don't rule out an asset class or a location just because of a bias. That's what a lot of people do.
The regional markets have strong commercial sectors. It's in many ways the heartbeat of these regional towns is their economies, right, which is driven through commercial property. So in order to get your money to work harder for you probably need to go to the regional towns in order to get bang for your buck.
Yeah, I think so. And like even if you got $5 million to spend, like $5 million in Brisbane gets you a fairly medium size, like not that exciting warehouse at a low yield. If you take that $5 million to a town with 50 to 100,000 people in it, you're probably talking shopping centres. So you might get 4 times the building size. You might get 3 or 4 times extra tenants. Like you've got a better yield instead of it being 5.5%. You're 7. Like it's a considerably different deal. So the argument a lot of people kind of fall on is, regional's more risky. And it is if you're buying in the wrong town or it gets bypassed or whatever it is. But you can actually do a lot better in regional towns, which we'll go into as well, because things can be amplified. So like infrastructure spend as an example, if there's a big spend or a new hospital in, I remember in Port Macquarie many years ago, that has a direct impact quite quickly on both residential and the commercial markets. You put a new hospital in an already built out, overpriced capital city suburb, it'll change it, but not to the same degree. So there potentially is quicker and faster, or I guess quicker upside for infrastructure spends and many other kind of growth drivers as well. So
from a first principle point of view, then you're completely agnostic, rural or regional or metropolitan. It's just the basis of the deal.
Yeah.
How does it stack up? What are the opportunities and upsides for it?
Yeah. And I've always been like that as an investor, and it's funny, that bias is still quite prominent in commercial. Like I think it's less so in residential. Like the buyer's agent world has really dealt with this subject a lot in the residential space, and that's why people are mostly buying lower value houses for a bit better yield and buying more of them rather than just go inner city Sydney and buy one property, negatively gear it, and you're done. The same method should be applied to commercial. You just got to probably, buy the best deal you possibly can. It doesn't matter what the suburb is. You just got to do your due diligence and make sure it's a good one.
And that best deal for you is going to be dependent on what outcomes you're looking for. So I imagine a lot of people would be happy sort of parking some dough in a pretty average shed in the suburbs of Brisbane for $5 million versus owning a shopping centre. It's got to come down to where you are, your investing journey, your risk appetite, cash flow versus capital return, all these different nuances which help determine the shape it. But I don't know, maybe like in resi property, there's a bit of prestige owning more, and people still get obsessed with how many properties they own. And for someone to say, I own 17 shops as part of a, all individually sort of tenanted and generating cash versus one shed in Brizzy, bit of ego around it as well, right?
For sure. And like I always say, it's about the rental amount you're getting. Like it's not how many deals you've got. Like a lot of my high net worth clients have gone full circle on this topic where they've bought, especially the ones with us like in the early days where we started buying $1 million warehouses and they doubled. Like they've like most of them sell up those deals and then just go into larger assets. And it's more of a flex owning a couple big ones, I think, than, a portfolio of low value, kind of stock that kind of causes you a lot of headaches. You're rather the international tenant or the 10-year lease to a well-known business that's been in town for 30 years. Like it's more stable, and these are the deals you'd prefer to hold into your older age. There's less going on, and sometimes that's a nice thing.
Simplicity is key, right? It's easy to be busy, but are you being effective is a key thing. If you're chasing your tail on a whole bunch of commercial assets, you got to massage all the time. It can get quite fatiguing, and it can really lose its appeal. I know you've sort of been pretty active in this space around sort of regional markets. You did a piece the other day for API magazine, which was pretty good. But I'm sure we can give a lot more detail. I think the key thing would be maybe one of the biggest misnomers in and around property investing. One would be you only invest in commercial property for the yield because it doesn't grow at the same value.
Yep.
I think we've dispelled that many times. There's certain commonalities between performance between resi and commercial property. How does it look though in terms of capital growth for commercial property, regional versus metro? Is it different?
Look, fundamentally, it's not. They grow at different times and speeds, and there's, I guess, the way to summarise it. They roughly grow at a similar rate, but the variations of growth will be a lot more uncertain with residential markets. So, for example, right now Townsville is redlining. It's going hard at the moment, but it had a decade of flat growth, and now in that same time, Brisbane was growing, as an example, or they're just growing at different speeds, but. I'll give you some anecdotal evidence from Rethink over the years. So the current cap rate, I'll look at Townsville, Mackay and Rockhampton. So right now the average yields, we're buying a vanilla sub $2 million asset, not a national tenant, 3-year WALE. So I'm trying to be as standard as possible. Townsville, the yields are going to be 6.25 to 6.75. So the average of that's 6.5. 3 years ago, that same market was sitting around 7.5 average. So there's been about a 1% yield compression in that market. We've assumed a 10% growth in rent in those 3 years. And that's pretty generous because you would have had that large CPI rush at one period. So, let's just call it 3 sets of 3% compounding on itself. So basically 100 grand of rent valued at 6.5 would give you a value of 1.33 million 3 years ago. Now you've got 110,000 in rent and the cap rate's at 6.5. So 110 divided by 6.5, you're looking at 1.69 in valuation. So that equates to 27% growth over 3 years, 9%. So 9% per annum is what you've got over the last 3 years for the average Townsville asset. So as rates grew in that time, so there was a yield, I guess, decompression. So basically the market was affected. It affected the capital cities more. Like the famous story is the strongest market, which was the industrial, went from about 5% cap rates to 5.5%. So, it expanded by 10% or dropped in value by 10%. In same market, we've seen a 30-odd% growth in Townsville. The same applies for the other cities. So Mackay, we're looking at 6.5 to 7 in the current market, but we're buying at 8% all day, every day.
Yields.
Yeah, back in the market. So that, when you do the same calculation, equates to 30% growth. Rockhampton, it's about 7% cap rates these days. It was about 7.5 a few years ago. So that equates to 17% growth. So you can see they're all growing. And these are, some markets would have done a lot better than these and some a little bit flatter. But it just goes back to the whole saying, why do people think it grows less? Because commercial's attached to build costs. Yes, the land's cheaper, but the building and the leases underpin more of the valuation story. So, our job is to pick the right markets at the right time and, get a sturdy tenant that gets you through these times, and you should get growth plus good yield.
Yeah, I want to talk about Townsville quickly, but for some of our newer listeners or viewers, just pick up a couple of, you've moved through those numbers pretty quickly and they may be sitting there with their head spinning. You're talking about yields, you're talking about cap rates, you're talking about WALEs. So let's just quickly go back over them again. Definition of a yield for our newer investors.
So capitalisation rate is the market that is getting priced in for a specific asset. So the higher the yield, generally the higher the risk to the average market. There's obviously going to be good value yield and then poor value yield, and that's for the investors. I guess that's the eye of the beholder type thing. But a yield is a net yield. So if it's 7%, basically if you're getting 70 grand of income and the net yield's 7%, that's $1 million property. So you value it off the lease. So when that rent grows, you automatically get capital growth. So one of the beauties of commercial property is you almost guarantee growth if that rent is going up. So WALE, weighted average lease expiry. So the longer the lease, there might be multiple leases in there, so you've got to average them out. The longer that is, the better it is from a security point of view. that can affect the cap rate because people see it as safer, so they'll pay more for that same rent. So instead of it being 7%, because you've got a 10-year lease, some low-risk wannabe investor might say, look, I'm happy with 6% there or 5%. So instead of paying $1 million for that 70 grand rent, they might pay 1.2 just because they don't want to have to deal with lease reviews and renewals and stuff like that. So it's hard to kind of gauge it unless you're in it all day. And this is where you need to be in it or get expert help. But everything is tweaked around to come to a valuation at the end of the day. So
can the valuation of a property increase even though the yield stays consistent? So this is this is a big thing around commercial property. Say residential grows faster, the market moves it, right? Can you only structurally grow the value of your property, your asset, through increasing the rent, or will the market also do some heavy lifting for you?
It'll be both. So it can go the other way. So rising interest rate environment, you'll generally see values stabilise, sometimes even go backwards. The general rule is the lower the yielding asset, the more it's going to get affected by an interest rate rise, because people's cost of money is higher than the interest. Like, it doesn't justify the purchase, so they don't buy. If you're going regional, where the yields are 6, 7, 8%, and your interest rate goes from 5 to 6%, who cares? You're still making a positively geared investment on 100% debt. So if anything, it's almost a counter-cyclical play. Sometimes, like the towns we mentioned, they do better when the interest rates rise. When the interest rates go up, the more affordable suburbs get targeted a bit more because it kind of pushes everyone downhill. And same goes with commercial, but the equivalent is a higher yielding investment, gets targeted more. And then when the interest rates are dropping, you'll see those lower yielding investments, like those capital city, those ones in the middle of the city warehouses, they'll get targeted more because they're viewed as a growth only asset. And people are happy to not collect any cash flow on those ones.
So going back to Townsville then, Townsville's really driven forward in terms of capital values in the resi space. Do you normally see these two things working in unison or in parallel? If you have sort of significant resi price growth, does commercial normally follow suit?
Oh, not really. It's driven by two different types of investors. Like I know residential, because I've followed that market very closely because we've purchased over 400 commercial investments in Townsville since 2017.
400?
So we've gone heavy in that market.
Really? Wow.
We literally bought everything worth buying. And the main metrics I love there was you're buying so far below replacement costs. It just, you couldn't lose. We were buying $4 million warehouses that would cost $7 million to replace before you bought the land. So I'm like, well, they're not going to build anymore here. And it's happened. The only things they can build there are small warehouses where they charge a ridiculous rate. But a big warehouse, unless there's a blue chip tenant lined up, no one's building. So that equation will change because prices are growing 30-odd% in the last 3 years. So the builders' margins will creep back into it if they haven't already. But we've bought every corner of Townsville. It's a great market.
So we think investors own most of the commercial real estate in Townsville. That's worth
under the 10 mil range. We've been featured in the newspapers up there and everything because of the volume we've done. And
are you the key to the city?
No, they'd probably hate us because we've pushed all their prices up, maybe because that's the prestige is there. But we're less active in that market now because the value isn't as much as it once was. There's still good deals there, but look, it's still got a great long-term story. But it's amazing to see the flock of buyers agents because the data guys have seen that the residential market made sense all of a sudden. And they've all piled in, and there's more buyers agents than buyers than that market can handle. So I think the growth rates have been staggering there the last couple of years.
Probably due a trip up to Townsville. I've been meaning to go up there for a little while. So maybe
the minister or something up there.
Philip Thompson, MP. He's the minister for Townsville. He's a good guy. We should go up there. Maybe record this podcast up there. I've been trying to find an excuse to go up there. It's a long way. I've never been there before.
It's like flying across Europe, isn't it? Distance.
It's really a long way. So you spend a lot of time in Townsville?
Not much. No. We've
you look at the spreadsheets.
It's like we've got a guy based up there, and he does a lot of the sort of local stuff up there. But it's a real good market in terms of like relationships. Like we actually had Sean a long time ago from Townsville. We did a whole episode and did a Toowoomba story on it as well. That was a while ago now.
That's right. A couple of real estate agents out of
just good knockaround blokes. They've I like dealing with people up there. They're just they're down to earth and but they're getting less stock now because people are holding on to commercial assets. So the general story since that episode is people are holding, not selling. Because the locals, it was interesting. They came out of a 10-year rut where they just couldn't sell assets as easy as they could, and all of a sudden transactions were happening. So that's how we did 400 odd deals, because we were kind of we're unearthing the market because of previous sales, and we knew the value was there because it was cheaper than Mackay, it was cheaper than Rocky, like per square meter. So we bought everything we could, and now they all have seen the growth and no one wants to sell. So it's now a holding market.
There you go, as long as the business conditions remain solid up there, because that's what sustains the
And
property.
it should. The population growth, you've got the big defence force up there, like the way the world's gone, Townsville is strategically more important than it ever has been for Australia.
There you go. Well, that's just one case study with Townsville's, but you see this play out right across regional markets in Australia. So that's on capital growth. So same question, but in relation to yields, you're saying that you get better yielding properties regionally comparative to what you see from a metro point of view. This is a question of value, and strategy. How do you think investors should consider these sort of different yielding assets to help shape their decision making?
Well, look, you need a good enough yield to have a self-sustaining portfolio. So
is that a fundamental point of yours? You don't want to. You largely you want to avoid being negatively geared.
Yeah, if you're negatively geared, you don't have a portfolio worth holding. Yeah. Like, yes, you might have a good job and you can suffer for a little bit, or the rent rises will come in time. But this is one of the big problems we're seeing with huge amounts of investors. A lot of them come to us because Rethink is known to get better yields than the market. Like, that's kind of almost our
commercial.
And like from day one, we've always been kind of seek higher yielding properties. And it doesn't mean sacrificing capital growth. We just don't sacrifice yield for growth. We need a bit of both. So we're still buying, as I said, 65% of our deals in capital cities, but we're not going to be buying a 5% flat yielding investment that's got a bit of risk on it, where others might see that as a fine yield, but we want 6% in that market. So there's 20% difference in price on terms of yield. So, we restrict ourselves a lot on deals to maintain a good enough yield, because you've got to have that portfolio that can stand on its own 2 feet rather than you backing it. And, even a lot of medical, we've had so many kind of doctors and surgeons over the years come to us who've got that real high-paying, secure job, but they've got 10 dud properties that are negatively geared to the tune of 300 plus K a year. And then they got their, 2 kids in school, private school fees, and they're going to pay for their uni. And then they've got their house in Mossman. All of a sudden, 2 7-figure jobs after tax, minus those costs, they're not rich. And they wonder why, because the portfolio is kind of one of the big boat anchors there. So we kind of, that's why we've got guys like Patrick, Rethink Wealth, someone who can just go in and say, look, maybe you need to sell 3 or 4 of those properties and just get into just reverse the yield story. Like, get out of those 3-4% gross yielding assets and get into a 6-7% net yielding property. You can change it by hundreds of thousands in just a couple of moves.
So this idea of risk and reward, you're getting higher yields in regional markets because of perception around risk. Yep. So how do you compensate for these? Or do you just got to absorb it and assume that's just the way it is? And it shouldn't really negatively influence your decision making. Yeah,
and that's almost like a stockbroker's type comment. Like, the higher the yield, the greater the risk, and it's true in the law of averages. If you look across the entire market, but I've never seen a specific regional deal as riskier than a specific capital city one. Like, I'll use an example. If you're buying, I don't know, a KFC on a highway, it's got 25,000 cars going past it per day. If that's in a regional city, or, Moorebank in southwest Sydney, it doesn't matter. It's the same road. Like, it's still prone to a competitor going upstream on that road. Like, still costs the same to build the thing. The land's going to cost a lot more, so that's where you'll lose some of the yield. So if anything, you're copying a lower yield for the capital city just because of the land value alone. It's got nothing to do with the risk. and that's where the nuances can come.
So it's the
into
right sort of assets in regional areas, because
Correct.
KFC in Toowoomba or KFC in Townsville is the same as the KFC in Moorebank. They sell the same chicken and
exactly
the same people are buying them.
Even industrial properties, it's pretty hard to There's oversupplies in many parts of the country, and some of those markets are capital cities.
Yeah.
Because they just have large swathes of land that gets rezoned, and they'll just build all at once, and it takes time to absorb that excess stock on the market. But in regional areas, things just happen a little bit slower. So I feel like it's more predictable. Again, if you just take the extreme example, if you get it wrong in regional, you get punished a lot harder. So the extreme would be you buy that KFC and then that road gets bypassed. Then you've got a red house on a highway that no one wants to rent. That's going to be a disaster story. And the land's not going to be worth that much. But, if you're buying in the middle of that little CBD, it might only be, 500 metres long. But those buildings have probably been there for 100 years and they've been tenanted 98 of those years. You just got to look at the history and what's going on in that area.
So it's different sorts of risk, and a lot of it's contingent risk. And imagine all of the fundamentals or basics of investing in resi property in regional towns is consistent with commercial, as in don't invest in a single economy town. Make sure it's very diverse. Make sure there's a whole bunch of different ways that people make their money. All this stuff is absolutely consistent with commercial.
That's the easy bit. So the generalizations you'd use for residential, you just do it for commercial. But just remember, you can then maneuver around the risk with asset classes. We were buying a few properties near the medical zones in Coffs Harbour and Port Macquarie many years ago. They're right next to a hospital. You've got a pathology there that's been there for 20 years to a national business. That's as strong as anything. There's an expensive fit out. There might be a slight premium due to the medical nature of it, but that's kind of 9 out of 10 in terms of the security value. So regional didn't really come into the equation at that point.
And generally, and this is a general point, yields are being compressed, and they have done since we've started this podcast. It's the 64th episode of it, so that means we've been doing this for 64 months, which is quite a long time.
Yeah.
We kicked it off just as really at the onset of COVID back in 2020. But yields inherently have got softer universally across Australia, irrespective of the asset. How low will it go? So, how do you get a sense for longer term investing in, particularly in regional markets, assuming that your yields probably aren't going to go up, they're only going to go down? Yeah.
Well, look, the summary of those 64 odd months is, you're right. We started, COVID hit, they dropped interest rates. We were buying things at 8% cap rates back then, and during that time, the interest rate was slowly dropping, or quickly dropping in some cases. So those 8% dropped to say 6.5%. So quite a significant, tightening of the yield. So that's strong capital growth. And then we had the interest rate rise, and that's actually meant the last 2 years have been the opposite, where basically a lot of markets stabilised and then the rent grew on top of it. Rents have been growing pretty quickly at the moment it slowed up a bit due to the CPI coming back down within the range it's meant to, but CPI was into the 7s, you remember. So a lot of rents went up 6% per annum and then 7% the next year.
So there's automatic uplifts on
straight
values.
Yeah.
So it's a good time to be an investor with yields going up.
Yeah, because the rents have grown and now there's been a softening and now we're in a downward cycle again. So, the current predictions are there's either 2 or 3 rate cuts this year. It doesn't matter what exact number it is, but, there's definitely looking like there's a strong chance of a rate cut in the next meetup. And if that happens, it's just going to put a fire under the commercial market. People are going to see less risk, so that means they're going to pay more for the same rent, so cap rates will drop. So the yields that you'll expect will get lower.
These are the sort of shifting dynamics, and people's perception of risk can shape how they choose to invest. And we're recording this podcast, and there's a rate announcement today. Is it today? It's coming downstream. I think it is. Yeah,
it's pretty soon. Yeah.
So probably in the next 20 minutes, we're not going to know. So we won't give an observation on it. But the overall sentiment is it's a downwards market. So that may give greater appetite for people to start considering their next investment faster because you assume rates are cheaper. You've made the comment to me in the past that it's hard to get a good it's nearly impossible to get a good commercial asset under $1 million these days, and to really be trading in reasonable stock as 1.5. Is that in metro areas or is that in regional? What's that sort of, what would you say that sort of floor is for identify? It's very general, but buying good assets regionally.
Yeah, look, good question. It's due to the size of the property. So you can buy small warehouses and you can go really small. Like there's people selling 10, 20 square metre things, like basically car ports in Melbourne, Sydney, Brisbane. The problem with those deals is you can't get proper finance. If you can, it's going to be some kind of weird loan that's not going to be around forever. So you can't rely on that loan to stay at that LVR forever if times get worse. So it's a finance warning straight up. So if you get a finance warning, it's probably not the deal for you. Larger deals can have that. So that's a different story, like where it might be 50% LVR because it's a specialist hospital or something. That's fine. When it comes to tiny properties, the reason the banks don't like them is the tenants. They're going to come and go. Like they're either going to grow or vanish because they've gone broke. So it's a generalization, but it's a pretty consistent one that, the smaller the tenant, the business, the greater the variability, or the less chance it's going to stay at that exact size. So you're going to have turnover. Turnover in commercial is not great because you've got to have a longer downtime. Like the whole beauty of commercial is you get longer leases. So you want tenants to stay long term and then you'll make way more money than residential that way. But if you get that constant turnover, you may as well have stuck with residential because your yield's going to come down every time the tenant's not there. There's cost to find a new tenant. You might have to make good. You might have to pay incentives to get the next guy in. Yeah, it's just a bit of a roundabout if you do that. So to answer your question, look, $1 million, you'd probably be in the small warehouse or retail space for capital cities, but you really just want something well located. Look at the supply of the market. Just be careful in that market. That's why I always say, look, if you've got to buy in that market, you have to accept that there's higher risk. So you will, and we're buying, probably 10 odd properties under $1 million a month, but generally that's where the problems happen in terms of tenants. So you got to be ready for that. And look, it's a stepping stone. The good thing is that $1 million property might turn to 1.5 in 6, 7, 8 years time. And then you've got equity to go again or sell up and then go bigger. You're in the market. It's a stepping stone. But if you take that same money regional, you'll just get a bigger space. So remember, the tenant might be more stable. Especially if you can get it over 1.5 mil, it starts to get a bit better then.
So what's sort of the sweet spot investing in regional locations, which gives you a nice balance of yield, risk, continuity, capital growth upsides? Like where's a nice number that's going to give you all those things? So
to start, to get the best of everything, you're probably around about 3 mil. And that's, you need about $1 million cash for that.
Yeah. Okay.
So, or equity. So, 30%, that's $900K plus stamps, all that stuff. So call it $1 million of cash or equity. And a lot of investors will have that tied up in half their residential portfolio or their family home in Sydney. It's a big number, but these days it's not that big as well. It is changing relative to, when we first started investing. So that'll give you freehold, maybe multi-tenant, good spot in town, like large enough deal. Once you start getting above that, I've got my one in Hervey Bay is probably worth about 6-7 mil now. I paid 4.2 mil back in 2018 for it. So it's grown a fair bit, but with that, it's Chemist Warehouse, a Food Works, a doctor, a dentist.
Like a little shopping centre.
Yeah. And it's got some upside. Like it's got a bit of everything. Like that's, call it a $6-7 million deal. That's blue chip, in my opinion. I'd never get a deal that good. Capital City for that money.
That's pretty good.
And it's quite new. Like it was 10 years old as well. So big depreciation. We've done the solar value adds to it. So it's probably pushing it over 7 now. So it's just an all-in-one portfolio. And 7,000 square meters of freehold land as well. So you can always do stuff with that long term.
Yeah. I bought this property purely for the opportunity to use an example on this podcast. The place that you guys got us out in Western Australia, a suburb of Perth, I got a val on that for my super fund audit.
Yeah,
that's at 1.6 now on a 1 million purchase price in 3.5, maybe 4 years.
Yeah,
it's not bad going.
Perth has probably been the unicorn of the last few years. Like, I was talking to our local acquisitions manager down there, and he's like, you're sort of 5.5% cap rates for that market. Like for Perth, that's sharp. Like, and I'm saying it from a national viewpoint. Like we're losing deals to randoms and other buyers agents who are paying like 5.2% cap rates. And I remember, like, I'd scoff at Sydney a couple of years ago at those yields. Now they're at a higher interest rate. They're doing that in Perth. And it begs the question, why? Why would you pay that much for Perth? And it's, I can't see the logic in it. But maybe people think there's going to be a bit more growth on the curve, like, because we were getting these things at 7% 2 years ago. So the yield compression in that market's been quicker than anywhere else in the country.
It has been.
So, happy days for you. You're the example of getting in early.
Right place, right time.
Yeah. You bought yours at about a 7% cap rate. Now you'd sell it to me for 5.75, or you might sell it to someone who's a little bit more desperate for in the low fives.
Yeah.
So
you have sort of land and capital movements have shifted quite a lot. Someone like the Brisbane Trade Coast, for example, the per square metre rates have rocketed in those areas. Like, what's driving those things? Yeah,
so land values across the country are really going quickly at the moment. So, an example, I was looking at the New South Wales Valuer General report. So this is old data. Like, we haven't had the July this financial year or the last financial year. So this is 12-month-old data. So there's been a lot of growth since then. But the average New South Wales industrial land values rose 6% the 12 months. And that was in that like high interest rate environment. Over the last decade, we quoted before, like there was 80% for Sydney industrial freehold over the last decade. So 28% average growth. Melbourne did 281%. Brisbane was about 170 odd percent. So significant capital growth. And that's driven by, look, it's the change in consumer behavior, more online. There's manufacturing is coming back on in some forms in Australia. There's also the fact that it's a popular asset class now as well. So that was one of the other factors, to go back to a previous question you had, what else can affect capital growth? It's demand from investors and owner-occupiers. So my business is a classic example. The demand for commercial is increasing rapidly due to residential not looking like as great a value as it once was. Plus, there is significant education out there now. So, like, it's not the boogeyman or, the unknown asset class that it once was. So there's a lot more people open to it. That means more money inflowing into it. So more money flowing into the same amount of, reserve of stock just pushes prices up. So we might see historically lower cap rates for all asset classes just due to more demand for no economic reason other than that.
And what are the big institutional investors like when it comes to regional? So we're obviously been talking about, I don't want to call them mum and dad investors, but sort of, just investors, family-orientated investors and all family offices, right, is the currency of the conversation that we've been having. But your big instos, are they getting more and more attracted to the regional markets?
They always were. Like, think about Stocklands, or, like, they've got shopping centres in some of the most regional parts of Australia. Most big funds have a regional portfolio, like regional industrial or a mixed blend, or, sure, there's the CBD big funds who just do the towers, so they're not going to be in regional areas. But there's always been a demand, like, because they need good yields for, I guess, because the demand's there from buyers.
So they'd be pigeon pairing then, these different funds, right? They're getting better yields in regional areas, but maybe therefore and channeling any upsides in that into more capital growth orientated assets in the cities, right?
There's many funds that are only regional as well, only in regional retail, for example. So there's a fund for everything, really. Yeah. I've found them normally they've been the big holders of properties. Just medium-sized funds hold a lot of regional Australia's property.
So the sort of boffins that sit inside those businesses to try and assess regional markets, would they be looking at similar things to what you and your team are looking at in terms of why a particular regional location is better than another?
Yeah, the thing they look at, first of all, it's got a fund manager needs to stack up a deal from day one. So the yield's got to be there, minus the debt costs, and they've got to pay out a certain amount to investors monthly, quarterly, or annually, whatever it is. And So they're always attracted to the higher yield because there's more fat in the deal, essentially. And then from that, you need to see if the risk or the chance of recurring income is strong. So tenant profile, what happens if that goes vacant? Is there other big tenants looking for it? So, if you went and bought one of those regional kind of small office blocks that might have the council in it, but there's a new building getting built. So if that council left, who are you going to get? You might have to rent it out to 20 different smaller places and always have 20% vacancy. So that's a risk that I personally wouldn't take, but some might see it as a value add because you can get more rent per square meter. But that's where it gets a bit sketchy, I think, with regional. But, if you're buying the ones I love, like, the local large format retail centre where you got your, homewares and the beddings and all those beacon lightings of the world, like they're rock solid,
Car park in the middle, shops around the side.
Yeah.
Happy days.
Every medium-sized city has that, and they're generally the biggest.
Would you be building that? Would you be buying it? It's challenging to build.
Good question. Like the building costs are starting to cap out, and now there's capital growth back on for commercial because yields are compressing. Like especially if these next interest rates drops, like we're back on. It's a bull run again. So builders are going to be back because they've been on the sidelines for 2 years. Some hemorrhaging large amounts of money just to keep jobs going, but they've been waiting for this period where the growth happened, build costs have stabilised. So it's now back into a more balanced market, but yeah, it's not quite there yet.
So is there a sweet spot where you can get all the benefits of investing in regional markets, but sort of proximity to the capital cities? Is there like a fringe that sort of operates in a unique way?
Yeah, you almost don't care about the capital cities. Like I remember one of the deals I was really disappointed we missed out on. It was a couple of years ago. It was when the interest rates started going up. Like it was a big homemaker centre around Bathurst, and it was about 30 odd mil, and it was nearly 8.75% interest yield on it. So cash cow this thing. It had an average weighted lease expiry of about 6-7 years. I couldn't see how you'd leave. Like even if one or two tenants left, like it was 100% occupied, and it was their flagship centre in town. And that's going to have probably a sphere of influence of maybe 30, 40 Ks around at 50 Ks. Beyond that, there's another super centre somewhere else, or so it's not really about capital city. It's about that sphere of influence. Like I think we've mentioned before on the podcast, a supermarket might have 5 Ks around of it. Like a Bunnings might be 10, 15, because then that's why they kind of keep plonking them all over the city, the country, because, people aren't going to drive 300 Ks for a Bunnings, but they might for a hospital, so they've all got different influences, you just got to understand that radius.
So people are willing to travel contingent to what's actually on offer. So you go to your local supermarket, a couple of Ks, 10, 15 Ks to a Bunnings.
Yeah.
Yeah, it's not a bad way to frame it. Why'd you lose that deal out in Bathurst?
We were too slow and got outbid by another fund at the time. So there's a big value add play there because the rents were under as well. So that's sort of one of the deals I wish like I was liquid enough I would have sold.
Were you buying it for you, or was it buying for a client?
It was for a client.
Yeah. Like just family office type stuff, or?
Yeah, exactly.
Yeah, okay.
So it was high net worth individual representing a family office, and everyone was a bit spooked at the time with interest rates. I was like, this is not going to wait around. Like this is one of those deals, and sure. And this is when funds weren't active because they were hurting at that point too. But a fund was smart enough to jump on that, and now that would look like the deal of the century.
That's a good thing with the free cash flow on it, to underwrite the debt against it. It's that would stack up pretty well, I would imagine. You just need a capital cost to get in.
Yeah. And the interest rate was 6% back then. Like, you're making, it was 2.75% coverage, and then the rents were all growing at 4% per annum as well. Yeah. So it's probably sitting at 9 and a bit percent interest now, and now rates are coming down under 5, so 4% gap on the margin.
So you'd be making money still?
A lot.
Yeah.
Yeah.
Be handy. Just find one of them. If you're just starting out, would you kick off in commercial in regional? Would you sort of be banking on some metro locations? Yeah, look,
I'd be open to it. Like, volume-wise, again, 65% of what we do is capital city. So, you might be slightly skewed towards capital city due to more opportunities because of the size of those markets. But Look, regional will probably, if anything, make it lower risk if you can get the right deal because you're getting something slightly larger. So budget dependent, really.
Or budget dependent.
Yeah.
And is there a lot of people out in the market at the moment that you're seeing with big bucks to spend, or is everyone still, most of your client base still operating around that sort of 2 to 5 mil?
Yeah, the bigger guys are back for sure. Like we're doing regular plus 10 mil deals like weekly now, and that was probably a year ago maybe once a month type of thing. Like there's 5 times those buyers at the moment, so we're probably doing 5 of those a month, and the odd 20-30 mil one now. So the volumes in the higher price points are there. We've still got the same issues where there's just not enough stock for entry level, and it's a good thing.
Are there better deals out there at the higher price points?
100%, yeah. Because you're just going to, get above the clouds in terms of where the crowds are. So, it's access to more. It's all about access. You get access to more deals. You can review more. You can take your time a little bit better.
Yeah.
In the more entry level price points, you're up against just sheer volumes of buyers. And it's not bad. Like when you go to sell an asset, you want that. But the reality is you're probably going to have to pay a premium to get in. So you might lose a year of growth because of your 10% premium you've justified paying. And that's never sat well with me. Like I want to get good returns for investors every year. I don't want to just
money on the way and
give a year away just to get someone in. Like that's.
So what would be your counsel to people then? Like in resi, they say just get in the market as fast as you possibly can.
Yeah.
In commercial, if it took you another year in order to raise the capital or configure your finances, whichever way you're doing it, to actually move up a price point of $1 million or $2 million bucks, would you hold and do that?
So if you're sort of under $1 million, just work out how you can get above that. Whether it's selling, maybe there's some kind of like pay rise or something coming in the future. Like the market is going to grow, but like if you've got a plan to get into a higher price point, it's generally around selling residential investment, then you're just going to get a better deal, and you're going to hold this deal for the rest of your life as well. So who cares if you lose 6 months, because you're going to have it for 50 years or 20 or whatever it is. So it's more important to get the right asset. Generally, the higher value, the better, because again, it's that access thing. You've got better selection of deals and bigger tenants and higher yield and longer leases and freehold versus strata. Like it all kind of creeps in the higher the price point you go. And you'd doesn't matter about losing 6 months or even 12 months sometimes.
That's good. So I've got a couple of questions here that some of our listeners have sent us because I knew we were going to do some commercial investing regionally. So real quick answers to these, Scott. How important is population growth when considering regional opportunities?
Not really, unless you're in a certain types of business that kind of is affected directly by that, or you're on the fringe, like where there's urban sprawl happening. So, if you're in the outskirts of Western Sydney and there's 5% extra people in that area every year, that's great. But if you're in the, a market like again, use a fast food restaurant, that road is probably already near capacity. It's not going to change much. So population growth is more, I look at stabilization. Like if it's going backwards, massive red flag. But if it's the same and you've got the existing status quo going on and there's no development happening, like it's all working. So it's going to keep working. So
you talk about utility then, you know, in fast food restaurants, like there's a road there that people drive on every single day. The same amount of people probably drive on that same road every day.
Yeah.
So the utility of that investment is that you should have continuity. If there is population upside, might get a few more cars on the road.
100%. And population upside will just equate to more supply of something coming on in the market in time, because you've got to build more roads, you've got to build more warehouses, more homes. So that can actually bring risk if you look at it that way, because if it creates competition to your little shopping centre you've just bought, that would worry you more than the shopping centre staying as is.
General question, and this is not one of the questions for our listeners, I was just thinking about it. Investing in airport precincts in regional areas, thoughts?
Look, this came up a lot back when the Badger East Creek stuff was announced years ago, and everything was already priced in. So, look, regional, my shopping centre is right next to the airport. Do I benefit from that? Not really. I actually know I don't, because most of the I've spoken to all the tenants over the years, it's the local community that buys out of it. We're next to a retirement park. So they're the people that walk over and buy from the supermarket, and they go to the dentist and the doctor. people don't go to the doctor straight off the plane, hopefully not. And then, that's, I haven't really benefited from it, but there's a servo next to us. They benefit a lot from people hiring cars down in the industrial site, driving, filling up and going to Fraser Island and that type of stuff. So, every property is so different, which is why I love commercial. It's like you can't generalize. You've got to know exactly the asset class.
That's the nuances you're talking about there. And this is the flywheel effect of, yes, you've got a regional shopping centre or a Coles or a Woolies or whoever at IGA in it. It's these the utility of people using that, which trade off each other and can continue to perpetuate it. What strategies can an investor use if a commercial property becomes vacant in a regional town?
So vacant, in recent times, like we found sometimes the best thing to do, I hate to say it, is get on the phone yourself. Like, because the property managers, like, yes, get them on it, put it advertised. You might fill it quite quick, but no one cares about your property as much as you do sometimes. Like, that's why even in that example I use, like I spoke to those tenants for a reason, because we lost one and nothing was really happening. So I called up the supermarket and said, what tenant do you think would want to go in that little vacancy the most? I asked about the demographics of the clients and all that kind of stuff. And we had a few ideas, sent some emails off. Like I had to direct the property managers in that case. But bad property ads are the common ones. So like, when a vacancy's been there for a while, like look at the ad and go, does that, like if you were a tenant, would you get excited to look at that? And it's probably a dark photo, the door's half closed. Like it's just common sense sometimes, but get really bloody good photos of that property somehow, like just paint it out, just make it look pretty so a business can imagine themselves in there. Go give a property manager the job for a month. If they have no results, go to another one.
Don't be passive.
Yeah, you got to be active, and it sucks. When you got a vacancy, there's no smooth way around it. You just got to deal with it. But remember, with commercial, the vacancies are concentrated. So you might have a 3 or 6 month vacancy, and then you might have the tenant for 10 years. So yes, it's painful in the moment, but once they're there, you've pretty much done with that for half a decade, hopefully.
Good question here. Do banks treat regional purchases differently from metro in terms of LVR or serviceability?
It varies again. Generally not, unless the town gets under a certain size. So if you're under like 20,000 people in a town, you might have a 10% less lending capacity. So instead of being 65, it might be 55 type of thing. So you can get hit a little bit like that. But then again, you can, like we were buying a metro surgery in Melbourne the other day, and they wouldn't lend over 50%. It was one of the best deals I've seen in a long time, because it was 15-year business. They've just spent millions on a fit out. There was a 10-year lease on it, like safest thing I've ever seen. But the bank didn't like it.
Good broker will help you out with that. But final question here, good one. Which locations are currently punching above their weight on both growth and yield? Can you give us some hot spots?
Yeah, good.
Which everyone loves.
So look, the hot spots would be all major regional cities right now, due to the fact the yields are better.
All major regional cities right across Australia.
So what's
a major regional city? Something over 100,000?
Over probably 75,000. So you like, let's look at Victoria, Ballarat, Bendigo, places like that going well. Albury, Wodonga's strong. You've got Newcastle's doing very well.
They're all strong resi markets as well.
Yeah, so and because there's a flight to yield at the moment. That's why I'm making this general comment. People want yield because prices have grown up. They've got equity in their resi portfolio. They might be doing 100% lend, so they don't want 100% lend into a 5% cap rate industrial property in Brisbane. So they're going to go a 7% regional city, and that's, the towns we mentioned, Townsville, Mackay, Rockhampton, places like that. Seen Darwin shows some green shoots coming through as well.
Yeah.
Perth, if you can get the right yield in that market, happy days. I like that long term, but it's just about, you just got to get that minimum yield for whatever your ruling is.
So closing thoughts from you, evaluating a market's long-term potential, how would you go about doing it if you were starting today?
Look, understanding where interest rates are going is kind of the macro rule with commercial. Like if you think they're going up much higher, expect lower growth. So if you have that, then maybe you target higher yielding. We're going into a falling interest rate environment, or at least whatever the terminal rate might be, it might be like, 1% lower than what it is today. No one knows. There's so many variables happening. But if that goes 1% lower in a year's time, you're going to see rapid growth in the next, 12, 24 months. So it could be a really good market. The trick is tenant security, because there's a lot changing with, there is weaknesses in this economy. Like, we've had a per capita recession. We've got a lot of changing consumer behaviour. The work from home thing's still floating around. There's political risk in places like Victoria with that. You've got AI coming into it. How's that going to change things? Decentralisation is a common theme out there. So that would actually help regional, by the way, decentralisation. But, capital city, population growth, people land in Sydney or Melbourne generally, maybe Brisbane. So that's going to be good for all.
Yeah, and final thought, I'll pick up something you just said then. If the Victorian government does mandate two days a week work from home, and that's if you can do it, will that have a tangible impact on commercial property prices?
It'll really help things like neighbourhood shopping centres, because more people, cafes will benefit. Office, there's already 20% vacancies down there.
Decentralisation and stuff, yeah.
Office is going to have a shocker. You may as well knock some of those buildings down while you're at it. They're not going to get filled. But they've got rapid population growth down there. It's already a weak economy down there, so retail's struggling in the, those strip streets, especially in the CBD, so it's going to get worse for them. It might benefit industrial because there's more buying and selling online. It's like almost a mini COVID effect. Whatever happened in COVID, it's not 100% lockdown, but, you 2 divided by 7 a week, or 2 over 5, so 40% more people at home. That could have pretty drastic effects.
Thanks, Scott. Really informative. Good to see you back. Episode 64. What's the best way for people to find you and your team if they want to have a yarn?
Just Google Rethink Investing for the commercial, or Rethink Residential for the resi. So there's
Rethink Commercial and rethinkresidential.com.au.
Yeah, and the residential's really been growing quick. Like, we've tripled our volume in residential recently, because I've seen it as more important now because of the price of commercial. I don't want to be playing around in that sub-$1 million range and telling thousands of people to do the same thing, because others are going to do that for me now. As you're seeing, a lot of the resi guys are in that. I'm going to let them play in that space and burn potential clients. But that's where the actual gap is. Just stay in resi, get a big enough deposit, and buy quality.
So recycle out of resi into commercial at higher rates, which isn't a new thing. And just on resi very quickly, then what do you like in resi at the moment? Because you're not chasing yield. Obviously, you're chasing capital growth.
So the same stuff we bought for 10 years, like just middle fringe suburbs. Don't mind a big regional city. Always freehold, 4-bedroom houses, that type of stuff. It's just the classic.
Price point irrelevant, whatever it is.
6 to 800K, you go a little bit more. You start going above that, your yield starts dropping. So, it's almost, as long as the prices can be found in that range, you go for them. If you've got to spend a bit more for a 5-bedroom thing, or, something a slightly better suburb, it'll pay off. You own a lot of those types of houses, as I do. They're always tenanted. They just set and forget. They don't break records of cash flow. The growth is pretty steady, but you buy them, and 5 years later they've gone up a fair bit, and go, oh, well, now I can recycle that.
They do become mutually geared in time as well, right? If you hold it
it's just a slow burn. You're not going to retire buying those, but it's going to help you get there.
Yeah.
You just got to then do something smarter with your money instead of just keep buying resi, and that's where we do the commercial. The
commercial stuff. Well, if you want to chat through that, reach out to Scott and the team. rethinkinvesting.com.au. You can find them all across social media as well. I follow Scott. That's how I keep abreast of where he is. He never answers my phone calls. I just see him on the social media and stuff like that. Thanks for tuning in, everyone. We'll see you again next time. Until then, bye-bye.